Look, your high income isn't making you wealthy. In fact, most professionals making $150,000 a year are building wealth backwards. You want to know why brilliant professionals making such good money still feel stuck? They're following the wrong investment order. Here's a surprising truth. The stock market isn't your best investment opportunity, not even close. As an investment advisor with 15 years experience in the financial markets, managing over $6 million in assets with over 100 members in my Fire OS community, I see this pattern constantly. Smart professionals with great incomes, but little real wealth to show for it. You're working hard, you're saving diligently, but something's missing. So today, I'm sharing the exact 12-step investment order that transforms high earners into real wealth builders. In this video, you'll discover why your income potential trumps market returns. You'll also discover the exact order to stack your investments for maximum growth. All right, let's get into it. Step number 1, invest in your money-making machine. Professional skills directly impact your earning potential. Many high earners focus exclusively on market returns, but the highest returns often come from investing in yourself. A typical investment in the S&P 500 returns about 10% annually. But when I work with clients, we consistently see 20 to 100% returns on strategic skill investments and education. I personally spent over $5,000 learning how to sell. And that's a lot of money. Most people would rather put that into an index fund or something like that. But within 1 year, I landed a new position with $100,000 in annual commissions on top of a $140,000 base salary. That's a 20x return on my money in just 1 year. No market investment comes close to that. Yes, there are risks involved. Yes, it requires effort, but unlike market returns, you have direct control over the outcome. Because in this situation, every dollar invested in your skills compounds throughout your career. Each new capability opens doors to higher earnings and better opportunities. Once you've actively invested in yourself, it's time to tackle the next wealth draining problem, which is high interest credit card debt. So moving on to step number 2, eliminate high interest credit card debt. Credit card debt creates a massive drag on wealth building. Many professionals carry balances despite high salaries. The math shows why this needs immediate attention. Consider this. If you're paying 20% on credit card debt while earning 10% in the market, you're losing money. I had a client with $15,000 in credit card debt who kept contributing to his investment accounts. He thought he was building wealth, but each year he was losing $3,000 to interest payments. That's $250 a month just disappearing. Some folks, they'll argue that they should invest while paying off debt slowly, but honestly, there's no legitimate investment that consistently beats credit card interest rates. The fastest path to wealth in this situation is clearing the high interest debt first. So here's how you do it. You want to list every debt interest above 8% and just attack it aggressively. This gives you an instant guaranteed return equal to those interest rates. You're not going to find a guaranteed return anywhere else, so tackle the debt. After eliminating high interest debt, you need a strategic cash buffer, but it's probably a lot less than you think. Before we move on to the next step, listen, learning this investment order isn't just the first step. Implementing it consistently while avoiding common mistakes requires ongoing support and guidance. I see this all the time. Smart, high-earning professionals understand these concepts but struggle with the implementation. Here's what they do. They second-guess their decisions during market volatility. They miss optimization opportunities because they're too close to their own finances. They make costly mistakes trying to go it alone. And that's why I created Fire OS. Financial Independent Retire Early operating system. It's a community and a course, but not just any community and course. It's a complete financial independence operating system with live weekly trainings, step-by-step guidance, and direct access to me and other professionals on the same journey. So if you're interested in joining, you can check it out in the description below. Plus, when you sign up, you get a free one-on-one strategy session with me to map out your personal path to financial independence. All right, let's get back to work. Step number 3, building your strategic cash buffer. So traditional advice about keeping 6 months of expenses in cash is completely outdated. That money loses value to inflation every day. We need a smarter approach to emergency funds. I've seen high-earning professionals keep $50,000 or more in cash, thinking it's a safe choice. But with 3% inflation, that costs them $1,500 annually in purchasing power. Plus, they're missing out on the potential returns, another $5,000 annually if you're invested in a simple index fund. I recommend just keeping 2 months of expenses in a high-yield savings account and investing the rest. For health-related emergencies and expenses, you can open a health savings account. We'll talk more on this later. And for protection against larger emergencies or home-related issues, you can set up a low-interest home equity line of credit as backup. This strategy keeps your money working while maintaining security. Plus, your emergency fund should protect you without paranoia. 2 months of expenses plus backup credit lines provide plenty of security while keeping your money growing. With your foundation secure, let's grab the easiest money available to you, your employer match. So step number 4 is maximize your 401k match. Your employer match isn't a nice bonus, it's part of your compensation package. Missing out on this is like asking for a pay cut. Yes, many professionals leave this money untouched. The typical employer match is 50, sometimes 100% of your contributions to certain percentages. I've seen it as high as 9-10%. This is an instant 50 or 100% return on your money. A client that I was recently working with realized that she had left $10,000 annually in matching funds unclaimed last year. That's not just $10,000 lost, it's $10,000 plus all the future growth that money has generated. Some folks worry about tying up their money in retirement, but here's the thing, with proper planning, there are actually ways to access these funds much earlier. So here's what I recommend you do. Calculate your maximum match and adjust your contributions to capture every dollar. This is the closest thing to free money you'll find in wealth building. Speaking of employer benefits, let's talk about the sometimes overlooked opportunity, your employee stock purchase plan. Step number 5, employee stock purchase plan. Many companies offer employees the chance to buy company stock at a discount. I've seen it as high as 15%. This benefit often goes unused because people don't really understand its power, but it's essentially free money with a simple strategy. Let's say that your company's stock trades at $100 per share. Through your ESPP, you can buy it for $85 a share. Some people hold on to these shares, which I think is really kind of risky. Too much of your financial life already depends on your employer. Instead, I recommend selling immediately after purchase. This is an instant 15% return, regardless of the market conditions. One of my clients using this strategy generates an extra $6,000 annually from his ESPP. The key is selling quickly and diversifying into index funds. Just know that if you're selling in a taxable account, it will be considered a short-term capital gain unless you've held the asset for at least 1 year, then it's considered a long-term capital gain. Just consult your tax advisor, and if you don't have one by now, you should probably get one. So here's what you do. Maximize your ESPP contributions and convert them to diversified investments. This creates a reliable extra income stream with pretty minimal risk. Now, let's look at the most tax-efficient accounts available. Let's start with the health savings account. So step number 6, invest in a health savings account. HSAs offer a unique tax advantage. Contributions are tax deductible, growth is tax-free, and withdrawals for medical expenses are also tax-free. This makes them super powerful, pretty much more powerful than any other retirement account. Most people use their HSAs wrong though, and they're spending the money each year in their current medical expenses. Instead, a potential strategy is to pay those medical expenses out of pocket and invest in your HSA for the long term. You can save your medical receipts and you can reimburse yourself even decades later, letting this money grow tax-free meanwhile. So a family contributing, let's say the maximum $7,750 annually, who invests rather than spends, it could accumulate to nearly $140,000 in just 10 years at 7% returns. Plus, after age 65, you can withdraw the funds for any purpose paying just normal income tax. All right, so here's the deal. Just maximize your HSA contributions and invest them for growth. Think of it as a super-powered retirement account with some added flexibility. With the HSA maximized, it's time to tackle the powerful backdoor Roth IRA strategy. Step number 7, backdoor Roth IRA. High earners often think Roth IRAs are off limits due to the income restrictions, but there are legal ways around these limits called a backdoor Roth. This strategy requires careful execution, but offers some valuable tax-free growth. The process seems complex at first: contribute to a traditional IRA, then convert to a Roth. Many professionals avoid it thinking it's too complicated or even possibly illegal, but it's completely legitimate when done correctly. The key is converting quickly to avoid gains in the traditional IRA. One client hesitated for months before trying this strategy, missing out on tax-free growth of $7,000 annually. The 2024 contribution limit is $7,000 for people under 50 or $8,000 for people over 50. That's money that can grow and be withdrawn completely tax-free in retirement. Here's how you do it. You execute the backdoor Roth IRA conversion annually to build tax-free retirement savings. This creates a powerful pool of money that won't increase your tax bill in retirement. For those with the right type of 401k plan though, there's an even more powerful version called the Mega Backdoor Roth IRA. So here we go. Step number 8, the Mega Backdoor Roth IRA. The Mega Backdoor Roth IRA can allow you to contribute up to $43,500 extra to your Roth accounts annually as of right now, the making of this video. This strategy requires the specific 401k plan feature, but for those of you who can use it, it's transformative. So many eligible employees never learn about this option because it's complex and poorly explained by HR. The strategy involves making after-tax contributions to your 401k and then converting them to a Roth IRA. A client recently discovered this plan and recently found out that he had missed out on years of potential tax growth. Yes, it requires some careful coordination with your plan administrator. Yes, the rules can seem overwhelming, but the tax benefits are enormous. If you convert just $10,000 annually and park in the S&P 500 index, in 20 years, you would have approximately $570,000. Here's the fun part. You would have paid taxes on $200,000 in contributions, but you pay zero tax on the other $370,000 of growth. So if your plan allows it, the Mega Backdoor Roth should become a core part of your retirement strategy. The tax-free growth potential is completely unmatched. All right, so with retirement savings optimized, now we're ready for those taxable investment account. So step number 9, invest in a taxable brokerage account. Many individual investors jump straight into taxable accounts, missing the more tax efficient options that we just discussed. But once those are maximized, taxable accounts can play a crucial role. The key is using them strategically. The biggest mistake in taxable accounts is active trading, especially for the individual investor. Every sale can trigger taxes eating into your returns. So instead, you may want to focus on tax-efficient index funds like VTSAX and just sort of dollar cost average into them. Hold them long term for deferred gains. Some investors worry about market risks in taxable accounts, but with a proper long-term strategy, market volatility becomes a lot less relevant. A client following this approach has built 6 figures in taxable account money while minimizing taxes through buy and hold dollar cost average investing in simple index funds. So choose tax-efficient funds and minimize trading. This creates a flexible pool of money that can grow substantially while managing tax impact. So for additional diversification, the next thing that I want to explore is private placement investment opportunities. So step number 10 is private placement investments. So private placement investments can offer returns completely uncorrelated with public markets. These opportunities aren't right for everyone, but for some investors, they provide valuable portfolio diversification. Many avoid private investments, seeing them as a little bit too risky or complex. But at this point, if you're looking into them, then you might want to consider it, but also do your proper due diligence. The key is finding opportunities within your expertise. For instance, a client in real estate development does well with private real estate deals because he understands the business. Someone without that kind of background might struggle. So start small, focus on what you understand, and don't commit funds you might need soon. Private placement investments can provide steady returns regardless of market conditions. Just consider private placements for a portion of your portfolio, but stick to areas that you understand and can properly evaluate. This brings us to perhaps the most popular alternative investment, real estate. So step number 11 is real estate investment. Real estate offers both appreciation potential and income, but it requires more work than most investments. The key is choosing the right approach for your particular situation. For instance, direct property ownership isn't for everyone. It requires time, knowledge, and often additional capital for maintenance. REITs, though, real estate investment trusts, offer easier access but with less control. A friend of mine bought rental properties without completely understanding the time commitment. He ended up selling those at a loss after being overwhelmed with just the management issues. So consider your bandwidth and your expertise. Maybe start with real estate investment trusts if you're unsure. They provide real estate exposure without the hands-on requirement. So here's what you do. You want to add real estate exposure in a way that matches your goals and capabilities. This might mean real estate investment trusts, direct ownership, or a mix of both. All right, finally, let's address any remaining low interest debt. So step number 12, address your low interest debt. Low interest debt, like mortgages, often causes stress despite reasonable rates. Many rush to pay these off early, but the math suggests a more measured approach. It might make sense to invest instead of paying these off first, which is why I positioned this one last. For instance, with a mortgage at 4% and 8 to 10% market returns historically, early payoff isn't necessarily optimal, but emotions matter too. A client with, for instance, a $300,000 mortgage at 3.5% insisted on paying it off early. Mathematically, investing would likely produce better results, but the psychological benefit of being debt-free was worth more to him. So consider both the numbers and your personal comfort level. There's really no universal right answer to this, but my recommendation is just to, if you have debts above 8%, pay the debt. If the debt's below 8%, then consider investing instead. So here's what you do. Make extra payments on low interest debt if you've covered all of the investments prior to this and if it helps you sleep better at night. But don't prioritize this over investments with higher potential returns. So each step in this investment order builds on the previous one, creating a compounding effect that accelerates your path to wealth and financial independence. The order matters as much as the actions themselves. So start where you are, but always keep the complete picture in mind. Thank you so much for watching. I hope you enjoyed it, and I'll see you in the next one.